Yo, what up traders? Welcome back to a new educational. We're going to be talking about the PDarray Matrix today. If you struggle with identifying certain fair value gaps, how to mark out a proper range, or even how to identify a high probability order block, we're going to go over all of that today. Also make sure to subscribe. I'm going to be posting 2 videos every single week, one educational, and every Sunday we'll do Simulation Sunday where I live trade with a random date. Now let's dive into this educational. Alright, the PDarray Matrix. Here are some topics we're going to cover in this video today. We're going to be covering what is the PDarray Matrix, what kind of elements are inside of that PDarray Matrix, and how to use all those elements as well. We're not going to cover every single element because we're only going to use the most important ones so you don't overcomplicate your system. And at the end, I'll show you 2 common mistakes traders make and how to avoid those. So first of all, what is the PDarray Matrix? Now to the left, we've got this nice rectangle outlined with a red box and a green box. So basically PDarray means premium and discount array. The P stands for premium, which is everything up in this red area. And the D stands for discount, which is everything down in this green area. An array is a different word for a list. So we've got a list of premium and we've got a list of discount. Now, what are the elements that are in this PDarray matrix? I've outlined them all inside of this rectangle here, and we always start off with an old high. This is the highest premium you can get in the PDarray matrix. Often people forget that the old highs are part of the PDarray matrix, but actually if you pay attention, and I outlined this in my time frame alignment model series as well, an old high is the best premium you can get for order pairing. Next up, we've got the rejection block. It's the wick that is attached to the old high. Next up, we've got the order block. This is an up close candle when price is bearish and a down close candle when price is bullish. Now, not every single up close or down close candle is an order block. I will outline later what a high probability order block is. Next up, we've got the fair value gap. The fair value gap is the best PDarray you can use while trading. I'm going to explain later how to use them effectively and why it's the best PDarray in the list. Then we've got liquidity void. I'll show you guys one example of what that looks like. It's not important for a key level and taking a trade from it, but it's rather used for draw on liquidity. Over here we've got the breaker block. This is when price moves up, takes out buy side liquidity, and then breaks structure to the downside. We've got a couple of down close candles at the start of the range where price takes out that liquidity, and this will be used as a breaker block. Now, not to confuse with a mitigation block, it's essentially the same as a breaker block. However, a mitigation block does not take out liquidity before it breaks structure lower. And we've got it vice versa for discount, right? We've got an old low, the best discount you can get. And again, order block, fair value gap, liquidity void, breaker block, mitigation block, but vice versa opposed to premium. Really appreciate everybody who is supporting me right now. Make sure to subscribe. We're going to be posting a lot of videos this year, so don't miss out. Now, how are we going to use these PDarrays? Like I said earlier, we're not going to focus on every single one of them. I'm going to outline the most important ones, which I personally use when trading, and we'll focus on old highs and lows, the highest premium and discount, fair value gaps, and order blocks. So let's go over a bearish example first. So we've got a blank chart over here. It's Euro GBP from 13th of January 2026. And if you look at the entire range, you always want to take your premium and discount from the highest low to the lowest low over here. So if we do that, we've got a premium and discount range. Now, from this step on, we can start to outline those PDarrays. So if I go to the next slide, I've outlined a couple of PDarrays, which are most important in my opinion. And we start off with the old high, of course. This is the highest premium you can get. And attached to that old high, there is a rejection block. So typically, and this is a nice tip when you're looking at trading towards old highs and old lows, when you are doing that on a daily or the weekly time frame, try to aim for the rejection block instead of the old high. So when you're trading the higher time frame, like a daily or a weekly, and your draw on liquidity is towards an old high, make sure to take your profits at the rejection block first. Typically what happens when price on the higher time frame reaches the rejection block, there will be a lower time frame retracement before it goes back to the old high. And if you take profits at your rejection block, you also avoid getting taken out by a cracking correlation between 2 markets. For example, let's say this is Euro USD and GBP USD actually takes out the high, but Euro USD rejects the rejection block then we can potentially form SMT and it will reverse. So when trading and taking profits, rejection blocks, in my opinion, are one of the best areas to do so. Now, attached to an old high and a rejection block is a bearish order block. This is always connected, and if it's not visually very clear that this is an order block, you're probably using the wrong range or not marking up your chart correctly. I will go over order blocks later in the video, but make sure this is always very clear in your chart. Next up, we've got this fair value gap, and it's very clear and objective because nobody can dispute what a fair value gap is. It is always 3 candles, right? One higher, leaving a gap in the middle candle and closing off with the third candle. There's zero subjectivity what a fair value gap is, and everybody can mark them out properly. As to oppose when order blocks are marked out, it's always sort of subjective, and we want to make sure we have the highest probability order block, and I will explain again later in the video how to determine those. Now if I go to the next slide, we've got this fair value gap over here, and I put a question mark next to it, because is this a good fair value gap where price can reject from, or should we look for another area? When you're trading fair value gaps and you're looking for a continuation, always make sure you're taking fair value gaps in premium before liquidity gets taken out. This is very important. I will show you at the end the common mistakes that are being made when trading fair value gaps. Now, if you paid attention, the list was a lot longer than what I'm showing you over here. There's not always a breaker block present. There's not always a liquidity void present. But what is always present is an old high and low, a rejection block, and an order block. That's always present. Right, let's go over a bullish range example. This is the DXY chart from 13th of January, so that's yesterday. And if we start off blank and mark out our premium and discount, obviously we're working within this range over here. Now if we mark out the bullish arrays, which I've done over here, we always start off with an old low and a rejection block, right? These are always attached. And then we got that bullish order block, which is always attached to the rejection block and old low. We see a fair value gap here. Is this a good fair value gap for a continuation higher? In my opinion, yes, because it's still in discount, right? And now I'm going to show you what is most important when trading fair value gaps and in determining order flow is using it like this. So this is an inverse fair value gap, right? So an inverse fair value gap is a fair value gap where price breaks through it, closes above it, and then uses the same fair value gap as a support level. So I use this as true support and resistance, and I've been doing this since 2022, and it's very powerful and very effective. Now let's go over liquidity void real quick. And what does it look like if I mark it out on the same chart? This is this big gap over here. Liquidity void is not your standard fair value gap like we have over here. It is a larger expansion where the candle is almost 3 or 4 times as large as those fair value gap candles attached to it. So this is a very small candle over here. This is also a very small candle compared to the massive BBC over here, which is a big black candle, right? And that is the liquidity void, which is often used as a draw on liquidity. And you can see this typically happen when, for example, CPI releases. There's going to be an extremely one-sided pressure and volatility, leaving behind a big gap like this. And once price bottoms out and hits a key level in discount, price often fills up the entire liquidity void before it starts to either reverse or continue through it and use it as a support level to trade higher. Now let's go over the old highs and the order block. And like I said earlier, the range always starts off with these two connected. It's very important. Let's talk about the signatures of actually setting the high and low, which also in turn makes what is a high probability order block. What's very important is a liquidity purge, right? So we have this 2 up close candles purging the high over here, right? That is step number 1. Sometimes, like I showed you in the previous chart, it does not take out the high, but on a correlated asset, it might take out the high. So then we form SMT, and that is step number 2. You always want to have SMT on your order block to make it a higher probability order block. It is not required, but as for my journal, I have journaled that 70% of my order blocks, which I marked out, were more effective when SMT was present. Step number 3 is displacement. If there are fair value gaps formed while price takes out liquidity, has SMT, and forms that order block, the displacement shows sponsorship, which means the volatility is one-sided and there's a reversal occurring, then all these 3 steps combined make for a high probability order block. Now let me show you the power of the fair value gap, and the fair value gap is the best PDarray, like I said earlier. I exclusively use fair value gaps as the single most important tool to determine if order flow is changing or it will be a continuation. And it also has to do with candle closures. And I will make a video about candle closures in the next couple of weeks to show you the importance of waiting for price to develop and where candle closures are high probability. So if we got this chart over here, this is a Euro USD chart, 60 minutes. So it's a 1 hour chart. We've marked out a range high to range low. And if we mark out our premium discount, very important, we want to identify where's that order block, where's that old high, where are those fair value gaps. If I mark out the most recent order block, and notice how these are 2 candles instead of 1 candle, but a series of candles can also be an order block. As long as they hit a key level, take out liquidity, have SMT on them, making it a higher probability order block, or if they are a continuation lag in current order flow. And I've marked out premium and discount of the order block, and you can see the bodies are respecting the mean threshold or 50% level of that order block over here. And this is extremely important because when you have a set of up close candles and it exceeds the mean threshold or 50% of that order block, very likely when the bodies close above it, it's going to be a continuation and it's going to run out a high. So if you see this signature over here, you can assume when price displaces away from it, that is a good order block and it will hold. And now you can start to use those fair value gap to your advantage. Now I'm outlining this fair value gap down here instead of this one up here. If you know why I'm doing that, I will wait a second. But again, it has to do with premium and discount, right? We're using this low to this high, and this fair value gap is in premium. When you're looking for buys, you always want to have your discount fair value gap, right? We don't long premium fair value gaps. We only use that when we're using inverse fair value gaps. For example, a bearish fair value gap being violated, we can use that as a support level and then continue up higher. Now, why is this a powerful signature? Let me show you. We've got a bearish fair value gap over here. And again, this one fails, right? Because we use this same fair value gap on the other side of the curve. So we have the buy side of the curve here, and then we're going into sell side of the curve. We use this area over here because it is a violated fair value gap, but we reclaim it back once we're in sell side of the curve. So if you have this signature of a violated bullish fair value gap overlapping and then reclaiming that fair value gap, it's an extremely high probability area where price reacts from and then goes down with current order flow, which is bearish obviously in this example over here. And to make it even more obvious, price does not even come back to premium. Often you want to see price come back to premium. In this occasion, it doesn't because it's such a powerful area where price rejects from. And I challenge you to journal these types of signatures as well, so you can spot them in real time when you're trading yourself. Now, there's also a possibility that this is the Euro USD chart, but GBP USD might have gone all the way up in premium, while Euro USD does not. And that is called SMT, right? Smart money technique with a dealing range, but that is more advanced and I would not recommend using that in your trading. You want to keep it as simple as possible, and when a system is too complicated, it gets harder to execute. Now let me show you 2 common mistakes traders are making when trading fair value gaps and not using the PDarray matrix to its fullest potential. Example number 1, using the most recent fair value gap after a major liquidity purge. Like I said earlier, if you want to find a high probability order block, typically it happens after a purge of a low, displacement away and SMT on that low. You don't use that fair value gap after you just took out a short-term low. You want to always have the most clear drawn liquidity present. That's why it's important to look for premium fair value gaps and not just the most recent fair value gaps, because you think price might go down from there. It all has to be mechanical. And this is the same chart I showed earlier with that powerful signature, right? That price rejects over here. And this is using a bullish fair value gap when you're still in premium of the range, which is over here, right? This is where price returns back into premium. And if you want to look for buys, either you do it when price comes back to discount of the range, or you wait for a CSD, which is a change in state of delivery, and wait for price to close above those down close candles again, and then look for that fair value gap. So this fair value gap actually will be used as an IFVG or an inverse fair value gap, and it is a very powerful signature for lower. I hope you guys found this PDarray Matrix educational helpful. If you did, make sure to like the video and subscribe, and I will see you guys in Sunday's episode of Simulation Sunday.